Saving money on taxes isn't just for big corporations or the ultra-wealthy. Everyday Americans can also take advantage of a variety of legal tax-saving strategies to reduce their annual tax burden. By making smart decisions throughout the year, rather than scrambling at the last minute, you can potentially keep more of your hard-earned money. Whether you're a full-time employee, freelancer, or a retiree, these top 10 tax-saving strategies can help you maximize your returns and minimize your payments. 1. Contribute to a retirement account. One of the simplest and most effective ways to reduce your taxable income is by contributing to a traditional IRA or a 401k. Contributions to these accounts are generally tax-deductible, and the earnings grow tax-deferred until withdrawal. For 2025, you can contribute up to $7,000 to an IRA, or $8,000 if you're over 50, and up to $23,000 to a 401k, or $30,500 if over 50. This strategy not only saves on taxes today but also helps secure your financial future. 2. Use a health savings account, HSA. If you have a high-deductible health plan, contributing to an HSA is a triple win. Contributions are tax-deductible, the money grows tax-free, and withdrawals are also tax-free if used for qualified medical expenses. In 2025, individuals can contribute up to $4,150, and families up to $8,300. An HSA can also be used to save for healthcare costs in retirement, making it a powerful long-term tax-saving tool. 3. Take the standard deduction or itemize, whichever is higher. Every taxpayer has the option to take the standard deduction or itemized deductions, depending on which provides the bigger tax benefit. For 2025, the standard deduction is $14,000 for single filers and $28,000 for married couples filing jointly. However, if your deductible expenses, like mortgage interest, state and local taxes, charitable donations, and medical costs, exceed the standard deduction, itemizing may save you more money. 4. Claim all available tax credits. Tax credits directly reduce the amount of tax you owe, making them even more valuable than deductions. Be sure to check your eligibility for popular credits such as the Earned Income Tax Credit, EITC, Child Tax Credit, American Opportunity Tax Credit, for college expenses, and the Savers Credit, for retirement contributions. Many Americans miss out on these simply because they don't know they qualify. 5. Adjust your withholding. If you've consistently received large tax refunds or owed a big tax bill in previous years, consider adjusting your Form W-4 at work. Increasing or decreasing your withholding allows you to better match your tax payments with what you actually owe. This way, you can avoid underpayment penalties or missing out on money you could have had throughout the year. 6. Maximize education-related tax benefits. If you or your dependents are paying for higher education, there are valuable tax benefits available. The Lifetime Learning Credit offers up to $2,000 per return, and the American Opportunity Credit provides up to $2,500 per eligible student. Additionally, you may be able to deduct student loan interest, up to $2,500 annually. These education-related benefits can significantly ease the financial burden of tuition and related costs. 7. Harvest investment losses. Known as tax loss harvesting, this strategy involves selling underperforming investments to offset capital gains from other assets. If your losses exceed your gains, you can deduct up to $3,000 of excess losses from your ordinary income. This move can lower your taxable income and help you rebalance your investment portfolio more efficiently. 8. Use flexible spending accounts, FSAs. If your employer offers an FSA, you can set aside pre-tax dollars for medical, dental, or dependent care expenses. In 2025, the maximum contribution for health FSAs is around $3,200, and $5,000 for dependent care FSAs. Although FSAs are use it or lose it accounts, some plans offer a short grace period or a small carryover amount. Planning your contributions carefully ensures you get the full tax benefit. 9. Deduct home office expenses, if eligible. If you're self-employed or run a side business from home, you may qualify for the home office deduction. To be eligible, the space must be used exclusively and regularly for business. You can choose the simplified method, based on square footage, or the regular method, based on actual expenses. Qualifying expenses include a portion of rent, mortgage, utilities, internet, and repairs, helping you save money while working from home. 10. Donate to qualified charities. Charitable donations to IRS-approved nonprofits can be deducted if you itemize your taxes. This includes not only cash but also goods, clothing, or appreciated assets like stocks. Always keep records, and if donating over $250, get a written acknowledgement. Donating not only supports causes you care about, it also reduces your taxable income in the process. There's no one-size-fits-all approach when it comes to tax-saving strategies, but by taking advantage of available deductions, credits, and smart financial planning, the average American can significantly reduce their tax burden. The key is to plan ahead and stay informed throughout the year. Small decisions, like adjusting your withholdings, funding your HSA, or maximizing retirement contributions, can lead to big savings when tax season rolls around. With the right strategies in place, you'll keep more money in your pocket and feel confident when filing your taxes.